Yeah, so hey, the Fed raised rates yesterday, widely anticipated. They went up by 1/4% or 25 basis points. It cooled in the short run yesterday. The markets backed off quite a bit upon that news, and upon the news that they suggest that they're gonna, the path is ideally, I think, 6 or 7 this year raises to the interest rate, targeting like 2% by the end of the year and then more next year. So that definitely suggests a much different environment. And some people are worried it's going to tip us into a recession. Obviously, I have no idea. It could. It could slow growth so much to where it does push us into a recession. So we'll see on that end. Obviously, hope that doesn't happen. Hopefully, what I think, they talk about the main purpose or some of the strongest rationale for doing this is to calm down inflation. I think really equally important, the Fed realizes they have a credibility issue, and they also with continued monetary kind of medication in the economy, they're pumping up asset bubbles, and that's not sustainable. It's not healthy. It creates a kind of a false financial and economic system. So I think they realize that as well. It's inflation. Obviously, they need to get a control of that, but they also realize they've got other issues around asset bubbles. So we'll see how this plays out. I think it's smart that they're going this direction. I think this is good overall. Not so good for stock market in the short to midterm run, but it doesn't mean that every company out there is going to struggle under this environment. And this is something I've been talking about for a while. So what does it mean for you in multiple levels as a saver, borrower, investor? So a saver, obviously rates are going to come up a little bit. That means in savings accounts and CDs and things like that, you're going to have a little bit higher interest. So that's a good thing. Now, if inflation's still running higher, you're still kind of going backwards a little bit. So as a borrower, a little bit more restrictive environment, going to be a little bit more expensive. So that's anticipated, and that's kind of by design from the Fed's standpoint. And as an investor, I think it means you need to be really keen around your bond portfolio and bond selection. You're going to be looking at funds that are more short-term oriented or more strategic and have some flexibility, because through this adjustment, bond prices are going to go down and kind of have a little bit more volatility. And we've already seen that because, like I said, there's been a lot of anticipation around this. So on the stock side and companies, I think this shift takes us from a place where growth and kind of vision-driven companies were doing really well, and we're going to shift to a fairly more traditional environment where companies that have sustainable, strong cash flows, pay strong dividends, rising dividends, those types of companies that have an extreme competitive advantage, or just, like I said, they have these very basic things that are doing very well for them internally, operationally. So I think the market's going to favor those types of companies. So we'll see. That, like I said, something I've been talking about for a while, not a novel thought. So I don't own it, but I do support it. I think generally that's good for our overall system. We need to calm down some parts of the market, bring some reality back into place. So, well, that's all for today. Take care.